Welcome. Today we are going to analyze Eisenhower Busch and Boston Brewing Company. And to make reference first, Anheuser Busch is company C when we're talking about it, and company D is Boston Beer Company. So first, let's start with talking about the two companies. Anheuser Busch operates as a holding company which manufactures and distributes alcoholic and non-alcoholic beverages. It operates in North, South, and Central America, Europe, Asia, Africa, everywhere, basically. And it also works with global exporting and holding companies. The company owns a portfolio of over 200 beer brands. The company was founded in August 2nd, 1977, and is headquartered in Belgium. The next company is the Boston Beer Company, is in the business of alcoholic beverages. The brands they work with include Samuel Adams, Twisted Tea, Angry Orchard, and Truly Hard Seltzer. The company was founded by James Koch in 1984, and the company is headquartered in Boston, Massachusetts. So now let's talk about the net property, plant, and equipment. Property, plant, and equipment are long-term assets vital to business operations and are not easily converted into cash. These things are tangible assets, meaning that they are physical things such as a plant where the beer is being brewed. As you can see, Boston Brewery Company shows a higher level of net PPE than Anheuser-Busch. This could be explained by the fact that Boston Brewer owns a combination of different brands, like I said before, that all have plants for brewing, different plants. Then on the next slide, we're talking about goodwill and intangible assets. First of all, we have to get things straight. Goodwill and intangible assets aren't exactly the same when you're talking about it. Goodwill is premium paid over the fair value of assets during the purchase of a company. Goodwill is tagged to a company or business and cannot be sold or purchased independently. Whereas intangible assets, for example, are like licenses, patents, and things like that, can be sold and purchased independently. As you can see from the numbers, Anheuser-Busch is higher because of it being involved also in non-alcoholic beverages and owning a portfolio of 200 different brands, compared to Boston only having Samuel Adams, Twisted Tea, Angry Orchid, and Truly Hard Seltzer. Although having these little amount of brands, they are still huge and widely known around the world. The next term is the total long-term debt. Long-term debt is debt that matures in more than 1 year. Long-term debt can be viewed in two different ways: in financial statement reporting by the issuer and financial investing. Factors such as proprietary or intellectual property and brand recognition are reflected in goodwill. As seen, Eisenhower-Busch is way more financially invested compared to Boston Company having zero. Brand recognition is crucial for the advancement of a company. Next is price and earnings ratio. The price and earnings ratio shows a company's share price to its earnings per share. A high ratio could mean that a company's stock is overvalued, or else that investors are expecting high growth rates in the future. This is a very important topic for investors. Analysts and investors review a company's ratio when they determine if the share prices accurately represents the projected earnings per share. As you can see in the presentation, the two companies are valued around the same place. Anheuser-Busch at 24.2 and Boston Brewing at 34. Boston Brewing is at a higher rate per share, so ideally I would recommend investing in Boston Brewing Company. The next is the price to book value. The price to book value measures to the market's valuation of a company's relative to its book value. The market value of equity is typically higher than the book value of a company. The price to book value is used by the by value investors to identify potential investments. Typically, the better investments are the companies with the price to book value ratio close to the number of 1. So these two companies, I wouldn't really recommend to invest in 2016. It would be a small gamble with them being at a 4.2 and a 3.9.
So the dividend payout ratio is the ratio of the total amount of dividends paid out to the shareholders relative to the net income of the company. So company C has a dividend payout of 88.2%, which is a great sum of money returned to the stakeholders, while company D has a dividend payout of 0%, which means that they don't return any money to their stakeholders, meaning that they have more earnings to invest within themselves. Current ratio is a liquidity ratio that measures the company's ability to pay short-term obligations to those due within 1 year. It tells investors and analysts how a company can maximize the current assets on its balance sheet to satisfy its current debt and other payables. Company C has a current ratio of 0.64, which indicates that they don't have the sufficient capital in order to meet their short-term obligations. However, company D has a current ratio of 2.1, which means that they have the sufficient capital in this case. The quick ratio measures a company's capacity to pay its current liabilities without needing to sell its inventory or obtain additional financing. The quick ratio is considered a more conservative measure than the current ratio, which includes all current assets as coverage for current liabilities. In this case, similar to the current ratio, obviously company D is better off than company C. Company D has a higher value of 1.35 and C of 0.41, meaning that D has better liquidity and financial health. Inventory turnover measures how many times in a given period of a company is able to replace the inventories that it has sold. So company C has an inventory turnover of 5.9, while company D of 8.5, which implies that company C has a slow turnover, meaning weak sales and excess inventory, while company D is the opposite. They have stronger sales or insufficient inventory compared to C. Receivables turnover ratio is an accounting measure that used to quantify a company's effectiveness in collecting its receivables or money owed by clients. So in this case, company C has a receivables turnover of 13, while company D of 25.3. This means that company D's collection of accounts receivable is efficient, and that the company has a higher proportion of quality customers that pay their debts quickly. A company's receivables turnover ratio should be monitored and tracked to any trends or patterns. Fixed assets turnover ratio reveals how efficient a company is at generating sales from its existing fixed items. Both companies in this case have similar values. So company C has a value of 2.2, while company D of 2.4. The higher the value, the better management of fixed assets. However, fixed assets turnover does not provide information on a company's ability to generate profits or cash flows. So the higher the turnover rate, the better. In this case, company B having a higher turnover rate.
Total debt over total asset is a leverage ratio that shows the amount of debt in relation to total asset. In the case, we can simply say that company C is higher than company D, as C is 66.0 and D is 28.5, meaning that company C is much riskier than company D. Long-term debt to equity ratio is a method for determining how much debt a company has taken on compared to equity. Company C is 95.2, which is much higher than company D, that is 0.1. Company D is much better than company C, as normally companies try to strive for a level of 2 or lower. The interest coverage ratio shows the ability of a company to cover interest in debts. Company C can cover their interest 6.5 times. The net profit margin shows how much profit a company is generating in proportion to sales. Company C is generating greater profit margin at 19% compared to Company D and only 10.3%. Asset turnover measure assists consumers is determining how much successfully business use their properties to drive revenue. Company D is better at 1.5 than Company C, which is 0.3, meaning that with less proportion of assets, they are able to generate more sales. And finally, the return on equity shows how well a company is managing the capital that shareholders have invested in it. Company D's shareholders earn 22 cents for every dollar invested, whereas Company C's shareholders only earn 20 cents.
Thank you
for
so much.
listening.